What's up, guys? I'm Nobody Special, and today we're seeing problems at yet another Chinese developer. This time it's Shimao Group Holdings. But there's something different about this one, and it may be proof of what I've been saying all along, that the China Evergrande collapse is not an isolated event, that it's not contained to just a few bad actors, that there is widespread systemic risk in the entire Chinese real estate market. And with this latest developer, Shimao, starting to have problems, the scope of this collapse could be much, much bigger now, and anyone is fair game. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And Shimao Group Holdings is yet another Chinese developer that's starting to show problems, starting to show signs of a liquidity squeeze, and early warning signs that it may not be able to pay its debts. And now there's some shady business dealings going on with one piece of the company buying another piece at a bloated valuation that's setting off a lot of red flags on Wall Street. Now, here's the rub. This is not a company that's been on anybody's radar. This is a company that does not violate any of China's 3 red lines policies, and they have an investment grade rating from Fitch. So the fact that this company is starting to have problems makes you wonder who else might be having problems. And this Evergrande collapse, this contagion, is starting to spread now to all corners of the economy, even some of the better positioned players, some of the companies that we didn't think were at risk of default. Now they're fair game. Now, folks, before we get into the numbers in this one, I have to ask, could you please like this video, subscribe to my channel, and don't forget that notification bell. It really helps me out, and I would be forever in your debt. And now it is that time when we must shrink my big, fat melon of a head. And let's get into this article. JPMorgan says Shimao deal is red flag amid liquidity concern. A transaction between a subsidiary of Shimao Group Holdings and a sister company is raising a corporate governance red flag amid tight liquidity for the Chinese developer, according to JPMorgan Chase & Co. Shanghai Shimao's announcement Monday that it will sell property management assets to Shimao Services Holdings Ltd. underscores increasing market worries that property managers are being used as a financial tool by developers, JPMorgan Chase analyst Carl Chan wrote in a note to clients. This connected party transaction not only implies tight liquidity conditions for Shimao, but is also a corporate governance red flag, as it is essentially transferring the cash from property manager to developer level, Chan wrote, downgrading Shimao Group and Shimao Services to underweight from overweight and slashing their target prices by at least 69%. So what happened here is it looks like one subsidiary of Shimao is buying out another subsidiary of Shimao for $259 million, and that's raising red flags. What could be going on is one part of the company that's bleeding cash and can't make its debt payments is being bailed out by another part of the company that's still making a little bit of money. And that's why they're saying this is raising concerns about corporate governance, because these are both publicly traded subsidiaries. So the shareholders of one are being looted to bail out the shareholders of the other. This could cause big problems with the exchanges. And the market is not taking this news well. Shimao is down 20% today, its biggest single day decline ever, and that's after it fell 12% yesterday. So the shares in this company are in free fall right now. And Shimao's bonds, not doing much better. They're trading at 65 cents on the dollar right now. And it's not just Shimao that are tanking on this news. All the Chinese developers are tanking. Remember that optimism last week that, China's central bank is going to ease liquidity restrictions and that it shows the government's going to bail them out and yay, the worst is behind us? Not so much. See, today, Sunak and even Country Garden, the biggest developer in China, their shares are down 10% on this news. Now, why are all of these other developers freaking out on Shimao's news? Well, it's because Shimao is one of those companies that everybody thought was in good shape. See, this whole debt problem started with this 3 red lines policy that was meant to limit the amount of debt that these Chinese developers could take out. And if a company violated all 3 of these red lines, then they were not allowed to take out any additional debt. That's what triggered the Evergrande collapse. Well, Shimao didn't violate any of these 3 red lines. So they looked like, on paper, they were in great shape. And if we shrink me again here, you'll see that they had just about everybody fooled, because here is Fitch ratings for the Shimao Group Holdings, and look at what we have here. BBB, triple B rating. Now, that's not a great credit rating, but that is the lowest level of investment grade credit rating. This was a seemingly healthy company that had some market risk, but they were still considered investment grade by one of the biggest ratings agencies in the world. Now, recently, some of Shimeo's bonds have been downgraded to junk status, but the company itself still had an investment grade rating. And now with this shady intra-company acquisition going on, it's got a lot of people second guessing that. And the ratings agencies, once again, are way behind the curve here because the shares in the bonds in Shimao Group are selling off like crazy right now, and yet the company still enjoys an investment grade rating. So what is going on at these ratings agencies? What's going on with the Chinese developers? And keep in mind, Fitch is still the only company who has downgraded Evergrande. Moody's and S&P have still not downgraded Evergrande after their default last week. They haven't. What's going on? Are the ratings agencies afraid to downgrade Chinese companies? Are they afraid of some kind of pushback from the Communist Party if they start downgrading these companies? We can only guess. But one thing's for sure, these ratings agencies are not doing their job. They are not giving investors an accurate portrayal of the health of these companies. And that's what investors rely on these ratings agencies to do. And this is one of the vital ingredients in the global financial crisis was the ratings agencies were not accurately handicapping mortgage-backed securities. And look what that got us. Making the same stupid mistakes all over again, folks. Now, I want to draw your attention to something that the company has put out here. Shimao Group has blamed the sell-off on unspecified rumors, but the company's sparse public comments on its financial health have only added to speculation that it faces a cash crunch. All right, so Shimao is saying all this sell-off in their bonds and their stocks has something to do with a rumor. They didn't say what the rumor was. They're claiming that the company is healthy, they're going to make their bond payments, but they don't offer any explanation for why is one subsidiary of their company buying out another, buying out or bailing out. Reading on, the Monday announcement that Shimao Services Unit had agreed to buy another unit of Shimao Group for $259 million was taken as a sign by some analysts that the developer is shifting money from stronger to weaker parts of the business. The deal's valuation was higher than usual, suggesting Shimao Group is essentially transferring the cash from property manager to developer level. They noted equity investors are increasingly worried about publicly listed property managers being used as a financial tool by developers that share the same owners. Property services companies including Sunac and Country Garden plunged at least 10% on Tuesday. Now, Shimao is not nearly as big as Evergrande, right? Evergrande is a much bigger outfit. Shimao is the 13th largest developer in China, and the company itself has about $10 billion in bonds, and I've read that one of its subsidiaries has another $15 billion in bonds. That's a combination of both onshore and offshore, so they're denominated in both dollars and yuan. But the big deal here is not the dollar amount. It's not the size of Shimao. The big deal is that Shimao did not violate any of those three red lines and that they had an investment-grade credit rating. Now, those two things are huge because that means the scope of this collapse has now got to expand to include all of these other companies that we previously thought were in good shape. Well, it turns out they're not. Why? Because nobody is buying property in China anymore. The Chinese real estate market is frozen solid. I mean, this shows that you cannot trust any of the numbers coming out of China about real estate sales, about real estate prices. These companies that a few months ago were seemingly healthy and not at any risk are all of a sudden doing these shady deals and at risk of missing their payments, and their shares and their bonds are tanking. Why? Because they're not making any money anymore. The real estate market is frozen solid. So we're not just talking about Fantasia and Kaisa and Evergrande. Now we've got all these other companies that could potentially be at risk. And keep your eye on that Country Garden. Country Garden is massive. Now, supposedly they don't violate any of the three red lines, and they still have a good credit rating. But after what's going on with Shimao, could we be hearing about Country Garden soon? It's just speculation on my part. But when you can't trust any of the data, when you can't trust any of the ratings, then you have to assume everything is suspect. And that's why I've maintained that China, the entire country, the stock market, the bond market, everything is uninvestable right now because there is just no knowing what is really going on beneath the surface in the Chinese economy. Now, full disclosure, I'm not a financial advisor. This isn't financial advice. Do your own research and your own DD. Arrive at a decision that's right for you based on your unique situation. But in my honest opinion, China is uninvestable. I would not touch it with a 10-foot pole. And also be wary of all of these analysts and these muckety-mucks from Wall Street banks here in the U.S. and from the banks in Europe, all these banks that are wildly exposed to Chinese developers right now. Watch out for them coming in the news and saying we're going overweight China and we're all in China because we think the news is baked in and that there's plenty of upside for 2022. Watch out for those guys because they are trying to unload this garbage on anybody who will buy it. And real quick, there's one other thing I want to show you in this article, and that's in this little video that accompanied it. Now, don't worry so much about what they're saying. I want you to take a look at what they're showing in the background here.
Shimao, which as of Monday still held both investment and better speculative grade.
You see what they have in the background there? That is Shimao credit default swaps. And look at the volatility in that CDS market. And that is one of those unknowable variables right now in this equation, is which banks have issued these credit default swaps, which are basically insurance policies on Shimao's bonds. If the bonds default, the banks have to pay. We don't know how many of these things are out there, how many of these derivative financial instruments, what the exposure is, and can the banks pay up? If all these developers go at the same time, are these banks going to be under stress? So there's just too many unknowables right now in this Chinese real estate collapse. Keep your eye on that. So long story short, now that Shimao, a seemingly healthy company that didn't violate any red lines and that had an investment grade credit rating, now that they're showing signs of trouble and they're doing these shady acquisitions between their own subsidiaries, now the population of companies that is potentially affected by this Evergrande collapse and the risk of contagion is so much bigger. That's why the market is reacting heavily to this news. Again, it's not the size of Shimao, it's not the amount of their bonds, it's what Shimao represents, a seemingly healthy company that didn't violate any of the 3 red lines and that had an investment grade credit rating. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget, give me a thumbs up, subscribe to my channel, and hit that notification bell. It really helps me out. I'd be forever in your debt. Until next time, live small and dream big.